Hello, my YouTube friends, and happy Friday. Hope everybody's doing well. Today, I'm going to talk to you about how you can turn 50,000 into $800,000. And I know some people talk about how to do this over a year, maybe 2 years, possibly even 5 years. Well, I have a strategy that you can get this done probably in under an hour. And it's really incredible. Now, keep in mind, like always, this is not financial advice. You need to do your own research and reach out to your financial advisor when making your decisions on how to invest. But this one's a keeper because I've been watching a lot of videos on these guys who are making 80 to 100% per year. And the more I dig, and then I watched a video on somebody using leaps. And I think that's what's going on with some of it. And when I started digging into it, I don't know that they really comprehend what they're doing. And I don't want that to be the wrong way. Because if one or two of you are watching the video, I understand you understand, but I don't think you really understand the risks involved. Now, for my strategy, living out here in Las Vegas, it's very simple because I live in Vegas. I'd probably do it with roulette, but blackjack works well too. You start with the 50 grand and I would put it on either black or red. And if I win, that's now 100,000. I would then maybe put it on the same or the other one, depending on how I feel. And I would take that 100,000 and put it down, and that 100,000 would then become 200 if I win again. And then I would do that two more times, so the 200,000 could become 400 and the 400,000 could become 800,000. I see that as a good way to take a risk on an amount of money that pretty much anybody can afford, to just see if they can turn that little bit of money into a nice little pile of something. Now, I hope you guys know that I'm joking, but let me explain a little of what I think is being missed on this strategy. So, a lot of them seem to use NVIDIA, and I'm sure that's for some random reason. It can't have anything to do with that it ran from $40 to 1,200, then split from for 10 for 1. And it bounced around a bit after the split, but now it's up to, I think it's $180 today. So the equivalent of 1,800. I'm sure that has nothing to do with them randomly using that one stock. But here is the underlying issue with leaps. One is you're leveraged. You may not realize it because you feel like you're only putting up X dollars. Now, I'm going to make up some numbers, but let's say an $160 leap, which is already $20 in the money, going out to January of 2027, because I think that's about as far as it goes out. It might go further, but I think that's about it. Maybe it trades for, I don't know, $50 an option or 60. So the thought process or how people talk about it is they only have to put up five, maybe $6,000 to wield 100 shares of Nvidia versus 18,000, and they're giving it up essentially, maybe 20 or possibly $30 of premium, which they just think of as, kind of like paying some extra rent to be long the option. And in some ways, you break even as it gets to 200 or 210. So there's a couple problems here. Let's not be super pessimistic of an out and out terrible crash, right? Let's just be a little negative and think things slow down, and maybe by 2027 Nvidia is down 10, $15 from where it is now. So it hasn't gotten crushed. I mean, maybe it went up to 250 and came back down, but I think some of the people selling these strategies haven't really seen different markets. They work great as long as things just continue to go higher. But in my example of by January of 2027, maybe Nvidia is only trading, let's call it 160, where your strike price is. Had you put the 18,000 in the stock, you now have 16,000. And yeah, you're down some money, a little more than 10%, and nobody likes to be down. I think my math is right. I'd have to double check. But if you bought three leaps instead, so you put out the same amount of money, you have zero. your 18,000 has turned into zero. And maybe you have sold calls against it as a strategy to try to increase that revenue. But you either have to be a phenomenal trader to make it work right, or really lucky that it's just a bull market that continues higher and outpaces the volatility index that has been put into NVIDIA. That extra premium is a computer calculated ratio that is usually pretty good at doing its job. Now, it works both directions, so if you're correct on direction, you probably do okay. But if you're clobbering it and you're making 80% or 100% annually, it's because either you are a very good trader or you've gotten very lucky. Markets don't always go up. They don't always do the same thing. They have corrections. It's no different than what happened in the late 90s with the dot-com bubble. Everybody was a genius because everything was going straight up. Now, towards the end, there were 4 or 5 IPOs coming out every day, shooting way higher than where they were, which is why I don't think we're quite at the point that this market has some huge correction coming. I just would like people to really understand that using leaps is a way to leverage your account. It is a dangerous strategy. It doesn't have this no risk, easy to do solution to be able to just make way more than actually buying the stock outright. There are risks. There is no new wheel that nobody's found, and there's a reason that they're priced the way they're priced. Now, I don't want you to hear it the wrong way because I also think there is a value to understanding and using leaps. Like, I think there's good reason to. But the good reason and the value is also the risk. Like, the leverage is okay. But what I would like is people to really understand it and not just think, oh, the markets always go up, because they're not old enough to have ever seen some of these down markets. 2022, I know we had a correction. I know there kind of was in 2020, and I know April was, but the buying the dip works until it doesn't work. And I'm bullish the market. I think people should be invested. I do worry at the same time about people investing using a strategy that really could wipe out their entire portfolio with the right type of correction. If you're properly diversified and you invest in without using margin and without using the fancy options and everything else, even in a big downturn, you're going to be down. Forgive me if you were in the NASDAQ at the dot-com bubble and bought at the high. To be fair, you were down 90%. But you would have been out of it and probably owing money depending on what you were doing if you were using some of these strategies back then. And if you just sat and owned the shares and didn't pay attention, well, the market ended up taking some time and going back up and making new highs, and we're significantly higher now. In fact, if you bought at the high of the peak and still owned, if I've seen a few videos on it, I have to, like, I think you still have made over 10. I think you've made like 13% return over the past, 25 years or so, which is pretty incredible considering you bought it at the, not you, at the worst possible time. Now, on a separate note, that popped in my head. I apologize for the video for yesterday. I probably will delete it at some point. I don't know when. It is what I think. I will defend it. I hope people who saw it make comments on it and tell me your thoughts, because I'm open to a discussion. I'm really rational about that stuff, and I don't get real upset. But I've just been getting frustrated about things I'd seen on the internet and felt the need to put it out. At the same time, if Lily, forgive me, if my wife sees it, she'll get annoyed because I get it. I don't want neighbors or friends or people who have a different opinion seeing the video, getting annoyed with me and having an opinion about us, who maybe it's people we like and just see things differently as to what's going on. Anyway, enough about that. Back to the finance stuff. But these strategies, yes, you have an opportunity that you might make a lot more money than just boring old investing. I get that. But unless you're actively paying attention and you understand them, which in that case, by all means, trade however you want to trade. But if some doctor, lawyer, garbage man, manager at a whatever, is using these strategies because they're following some YouTuber. It's very dangerous, and they may not realize the danger they're taking on. And if they're not on top of the positions, like it just may not work out the way you hope. Now, flip to the one I'm beginning to bang my hands on the table. I still really like United Health. I still see some other things that are cheap out there. It's tough for me because, like, I picked up Conagra recently, but it's not a company I really like. I think it'll take a long time, but I'm happy to get a 7% dividend in the meantime with a little bit of Conagra. Going back to it's boring. I get it, and I'm not going to get rich owning Conagra, but I don't think they're going out of business, which could happen in any stock. Disclaimer, you need to do your own research. But I think I'll get my 7% dividend. I don't think they're going to have to cut with their projections of what they're going to make next year. Even with a worse year, it still makes enough to be able to pay the dividend, and then they expect to grow going forward. Um, it's boring, and I'm not going to double my money, and I'm not going to leverage it and put on leaps or anything else because it just doesn't make sense for where I am. Now, it might make sense for somebody else, and if you have questions about that stuff, I really do understand trading, so I'm happy to discuss it and tell you my thoughts and give you my opinions of which one are good. Like even United Health, I don't think buying. I saw I was wrong earlier in the video. They have options out until December of 2027. And if I remember correctly, because I kind of glanced, the 250 call and it's trading right around 250 is trading for $60, which means, essentially if you're holding it till December of 2027, you're paying $310. Now it'll have ups and downs along the way if it gets there. And yes, you're able to buy or wield 100 shares for only $60 instead of having to put out 250. So you could buy 400 shares. But if it hasn't gotten up to 310, well, you're going to be down the equivalent of those 400 shares by December 2027. So you're just taking on more risk. Now, if it happens to get above there, yeah, instead of owning 100 shares, you're long 400, putting out the same amount of money, but that's called leverage. And if it limps around in 2027 December, it's still around 250, you've lost all $25,000, whereas the person who bought 100 shares hasn't lost anything. I hope that makes sense, and I'm happy to explain it more in detail. Like, make comments in the comment section if you don't understand or where it went awry so that I can explain it a little bit better. But I think these can be good strategies, but they're nothing new. And if somebody thinks that it's like this new, like that's just, it can't fail, it's simply because they haven't been around long enough to see enough markets to understand that things happen in the markets and it's not any guarantee. The other thing to be aware of is investing versus trading. Big difference in ups and downs, and I'll use my own experience as to what I've seen this year versus a friend of mine and what happened recently and his emotional ups and downs, because in my trading account I get very emotional, but there's a reason I put the bulk of the money into a set it and forget it. And like I said, it doesn't even have online trading. I have to make a phone call. It's kind of funny because some people get annoyed with the advisor because there are a lot of things that some places make easier. But what I like about this place is if my information gets breached, you get those letters every now and then that somebody got your information on your credit card or whatever else. There's nothing they can do in this account. It doesn't have online access. You can't do online trading. You have to call the manager, the broker who manages the account to do any changes to it. And he pretty much knows all of his clients. I mean, he knows my voice, so it's not like somebody else could call up and change my address or my bank information. And then the funny thing is just knowing him, if they even tried, he'd probably call me back and confirm that, did you really want to do that? So they can't even get into the account. It makes me super comfortable to have it there, and it's kind of why I call it a set it and forget it and think of it in a safe deposit box. He also stops me from being me because he knows my background as a trader, and I've told him I just want, like Amazon, I don't want to trade it. If it goes up a whole bunch and I think, oh, geez, it's gone too far, why don't I sell a little because I can buy it back? He'll laugh at me and say, we don't do that in this account. Go do it in your trading account. So that account had a huge down move back in March and April when the market corrected. It was very uncomfortable. Didn't do anything, just left it alone. Since then, it's slowly, and not so slowly considering we're only in August, come all the way back, and it's right near the highs along with the market. It's well diversified, it's spread out, and maybe people like the stock. I did a video on which ones I own. Maybe you like them, maybe you don't like them. Some are up, some are down. It is what it is, but it tends to perform about what the market does, a little bit less. My buddy who really trades his money. Now, I've told you I have a small trading account. I don't really compare it to the S&P because maybe on the day where the S&P is up, it's down percentage-wise a good bit. Like right now, I'm primarily trading HIMS. So when the earnings came out, it did really poorly no matter what the market did. And my options did well, the calls that I sold. Anyway, but it's too related to HIMS to really have any connection to the market. But my buddy called me up last week, kind of in this panic of like, are the markets worse than April? I've never seen them move like this. Well, he trades, and I call it gambling to some degree. And I'm like, buddy, because I don't want to say his name. No, we're nowhere near what it was in April. Yeah, we had a down week, but the markets are near the highs and nothing's going on. And this is why I continue to preach just investing and putting away and not trading and not paying attention. Now, if you have plenty of money that you can take 5% of your portfolio and go trade and think of it as gambling and have fun, by all means, enjoy yourself, watch the markets if that's what you enjoy doing, and be happy about that. But I would not take your portfolio and gamble it like that. Especially because what I've noticed is he'll even take stocks that are super boring and don't tend to move a whole lot. That my thought is you shouldn't buy that unless you really do plan to hold it for 3, 4, 5 years at a minimum. And he'll buy too much of it, get nervous when it drops a couple of bucks, talk about how it's been dropping for 2 weeks straight, which happens, and eventually gets nervous and sells it and doesn't hold on to what was probably a perfectly good company. Recently, the one that was used was Otis. I kind of thought, geez, it's near the lows. Maybe that's a good company to own. How much competition do they have? Now, I didn't dig into them. This is not a recommendation. It's just an explanation about the difference between gambling and investing. If you're an investor, find good companies that you think are going to grow over the next 5 or 10 years and be comfortable putting money in them, whatever companies those are. I tend to stick with good names. If I'm trying to time it, I try to stick with good names that have bad news coming out, which is why I like United Health. I try to be patient enough to wait, excuse me, to when I feel like that bad news has just been weighing on it and weighing on it. But sometimes I'm too early, which is why I've quantified like, I think I'm right about United Health. I think they're big enough that they're not going to go out of business and the government isn't going to put such a hold on them to just crush them. But I also think that the news may weigh for a while and I'm early on it. So I want to have 10 to 25% of what I want to put on by then. And I sold a cash secured put for, I think, December to maybe buy a little if it continues to drop. I think it could end up going to $200 a share. Some of me hopes I'm wrong. Some of me hopes I'm right. I know my personality enough to know that if it really does, I'll get nervous down there. But at the same time, I think it's a really good opportunity unless something new comes out that really makes it look like they're going to go out of business. When stocks are making lows, there's usually negative news. And when stocks are making highs, there's usually good news. I think Strategies of even buying stocks when they're making highs are really good strategies. Like anything works. And for those of you who don't pay attention, maybe an ETF like VOO or QQQM. But what I hope is that you put away and you continue to do it every month, every 2 weeks, every quarter, whatever it is when you get your paychecks and you put away and just make it a habit. I also hope that you enjoy life and you don't save so much that you don't even spend or do things you enjoy or anything else, unless you're trying to be the FIRE lifestyle and then you want to put away as much as possible so that eventually you can stop working and just live off dividends. But be careful with that too. A lot of these guys using those yield max funds and everything else for those high dividends to be able to live off of them, there's some danger in those too. And let me go over them again real quick so you understand. What they do is they buy a call and they sell a put instead of buying the stock. I'll explain that real quick. You buy a call. Let's use United Healthcare. So you buy a $250 call for next week because they're usually using weekly options, and you sell a $250 put also for next week. I haven't looked at the price, but let's say both of them are around $5 each. So you spend the $5 for the call, you collect $5 a put, you've put out no money. Now, the trading firm where they have the account is going to require them to have some sort of margin balance on that because they recognize that if the stock goes up, you're long 100 shares from the call, and if the stock goes down, you're long 100 shares from the put. So you do have the market risk of being long 100 shares, and maybe it's a dollar amount, maybe it's a percentage. Most of the time, it's a percentage, and if I were to guess, it's probably 20 or 25% of the position. Why do they do that? They haven't put out any money as opposed to putting out the 25,000 for the 100 shares, which allows them to do more than one on that investment. So maybe they'd buy two of those and sell two, or put on two of those trades, or three or four instead of one. Then they sell a call against the calls that they're long. So if they bought the 250 call, maybe they sell a 260 call to collect that premium that they're paying out as a distribution. I think they call it a distribution, not a dividend, because it's not really a dividend. Maybe they collect $3 to sell a 260 call, or $2, or whatever it is, and they're able to do that 4 times throughout the month, or 4.3 times to be more precise, and collect those payments every time they sell those calls. Well, the negative here is they're leveraged, and if the market drops, they're long that stock. So they have full downside exposure. If the stock rallies, by selling the call against it to be able to pay that distribution, they've limited their upside. So almost by nature, it guarantees that the stock is going to underperform. If they weren't leveraged, levered, I think I might have been right. If they didn't have the leverage, in a down market, they might actually outperform because they at least collected the money from the call as much as the stock is falling. But by being leveraged, well, unfortunately, they're going to underperform no matter what. If the stock moves down, they're going to be long more shares than just buying the stock. And if the stock really spikes up, they're going to get out by the calls that they sold. If you're getting into retirement and using one of these strategies, unless you're very lucky about the timing, eventually it's going to have a bad down move. It's going to get crushed. And even though as a percentage, you're going to be getting a nice dividend, the amount of that dividend is going to drop. So if they're paying an 100% dividend on a $20 stock and you put $2,000 in it, well, that's $2,000 over the year. But if the stock drops to $5 and it's still 100% return, your 2,000 a year has turned to 500 a year. And by the nature of these funds, that's kind of how they're designed to work. So it's probably going to drop unless the stock just has a consistent, continues to go higher and higher and higher, in which case you've gotten very lucky as to how it works. Anyway, no magic bullet, no magic pill, none of it works perfectly. There's reasons for every single strategy out there. I just hope everybody just puts away and saves, and you amass a good amount of money over the timeline of where you want to get. And if you're using that fire strategy, don't jump into these high yield stuff too early and run the risk of having some problems. Now, maybe a JEP-E or a JEP-Q, like they might be okay. They're a little less egregious and they're still using some margin, but I think they'll be a little bit better. Um, and look, even I own not really too much of the covered calls. I bought a little bit just to see how it works out because everybody's talking about them. But some high paying dividend type stocks and some REITs and stuff like that. So it's not like I totally disregard it. I just want people to have an understanding of what they are. Now, I also promised one of the subscribers that I would delve into the dividend account. The only reason I haven't is I tend to make changes in it. The only thing that I haven't made changes in is the set it and forget it account. So I worry about giving an example of my account if I'm not keeping up and constantly updating everybody. And then I make a change in my account and I don't make anybody aware of it and the market changes for good or bad. And for the example, I worry that something bad, like if I get lucky and I get out of something and it then goes lower, and then the comments in the comment section about why'd you recommend this and I bought it and now it's gotten crushed and like I do I worry like it's why I don't want people following my advice or following anybody else's. You know, if you hear something that makes sense and you like the idea, I get it. I do that too. I do it all the time with Joseph Carlson. I like his suggestions, but I've also done it with Ryan and Russ and you know a whole bunch. I know I'm forgetting some of them, but you know, like I get it, so I do too. You know, for the most part, I invest in Amazon, I invest in Google or Meta or some of the others, and then I gamble on Hims and I gamble on SoundHound or even Peloton or some of the others. And what I hope is I get lucky on something like that. But when I gamble, it's very small as a percentage of the account. Um, and the reason I use the example of going to the casino is to me that's kind of what it's like. So recognize if you're following these guys or hoping to hit the strategy where you make 100% return, that you are gambling to some degree. It is not investing. And really study and learn and recognize the trading and what you're doing. And if you're good at it, great. I mean, I was a very successful trader for a long time. It was a great way to make a living. I've just transitioned into investor because A, I don't need to take those kind of risks anymore. But B, back when I did it, it was different. There isn't floor trading anymore. And I really do think the edge that you had on the floor was such a big edge that I don't really see it so much trading on the computer. Anyway, one last time as another disclaimer, please don't listen to me. Do your own research. Don't listen to other YouTubers. When you're making financial decisions, you really either need to seek a financial advisor, do your own research, and make sure it fits your investment goals, not somebody else's. So, have a great weekend. Hopefully, I have time to do a video on Saturday or Sunday. I'm happy to be home. It's nice to watch the markets. It's nice to see that they've recovered from April. I do think we have more upside. I don't see us having a pullback anytime soon, which, you know, those strategies of having leaps should work during that. I only say it because I worry about when there is a correction, because there are from time to time, and it will happen. Somebody could get clobbered way more than they expect. Anyway, if you haven't already, hit that subscribe button, smash the like button, comment in the comment section. I like chatting with people. I do this because it's fun for me, not for any other reason. It gets my thoughts out. Have a great day. Enjoy your Friday, and I hope to talk to you soon.